Welcome to this episode of Wall Street Frontline. The Federal Reserve is expected to cut rates as early as September, even while inflation stays firm and growth indicators weaken. U.S. equities are still near record highs, with valuation heavily concentrated in a few tech giants. And at the same time, global trade tensions and tariff risks are adding new pressure on capital flows, especially in emerging markets. In this context, we're pleased to welcome Stephen Roach, Senior Fellow at Yale University and former Chairman of Morgan Stanley Asia. Right now, the market consensus is that the Federal Reserve will cut rates in September, but on the other hand, inflation remains sticky, and GDP growth and employment are showing signs of softening. So in your opinion, is there a risk that the Federal Reserve would shift to an easing cycle too soon, either under political pressure or due to economic risks? If so, what impact might this have on global capital flows and emerging markets, especially China?
Well, I do not think the Federal Reserve will adjust its policy due to political pressures. I do think, as Fed Chair Powell said at Jackson Hole very recently, that the Fed is concerned about shifting risks, largely focused on the labor market, noting that the indications of underlying indications of labor market activity point to a particularly fragile outcome going forward, which suggests that the unemployment rate could rise in the months ahead. And that conclusion, together with his view that tariff-related impacts, while they will boost inflation, that impact is likely to be temporary rather than permanent, is consistent with a more of an accommodative monetary policy than the Fed has embraced recently. The full extent of that, as always, will be data dependent. And this was not a huge surprise for the markets. They'd been, futures markets have been discounting a fairly aggressive multi-meeting easing ahead of the Jackson Hole comments. There's maybe a little bit more confidence in that outcome today than there was prior to his speech at Jackson Hole.
So, how many rate cuts do you predict there will be in the remaining of 2025?
Well, I'm not going to get in the business of predicting the number and the magnitude. I think I would just stay with the conclusion of the Fed chair that the balance of risks has shifted somewhat, not dramatically. And depending upon how the data play out, both in the labor market and in the inflation statistics, the Fed could certainly lower its policy rate somewhat. I think they'll be cautious in doing it for a number of reasons. Number one, the Fed is always careful in reaching dramatic conclusions on the basis of partial data. And number two, an aggressive move at this point would raise the possibility that the Fed was being pressured by political forces. And that's the last thing that this Federal Reserve wants to show at this point in time.
Previously, in an interview, you mentioned that the US economy is probably going to face a major recession risk in 2026, which is around next year. So, do you still hold that view today? If so, what factors reinforce your concern?
Well, business cycles don't last forever. And, we often have short-term cycles of both boom and bust. The U.S. economy now is slowing. There's little doubt about that. And that shows up in the GDP statistics, the employment statistics, and most importantly, I think, in the consumer demand statistics, where the growth rate of consumption is running at about half the rate of the past several years. And I think the risk of further downside correction in both the labor markets, consumer demand, and overall GDP will reflect the cross current of several developments, not the least of which are the tariff hikes, but also quite possibly a bubble on AI infrastructure spending by major AI providers. They're building like crazy. This is the one sector that is providing probably the most support to the U.S. economy right now, and I think there's a lot of redundancy in that capacity along the lines of what we saw with the rapid data processing capacity of the financial services sector in the 1990s, and I think there'll probably be a shakeout of that in the years ahead.
You just mentioned that the markets have cycles. US equities remain nearly record highs, but valuations are increasingly concentrated in the large cap technology sector. So, do you believe that the US stock market is entering a bubble territory? What effect or potential spillover risks would that have on global markets?
Yeah, I think the U.S. Equity market right now is overvalued, and I worry in particular about the concentration risk of the market focused acutely on the AI sensitive stocks, the so-called Magnificent Seven, and they now account for probably somewhere around 35% of the total market capitalization of the S&P 500, and that, by my calculations, is about 6 times the magnitude of the concentration risk that occurred prior to the bursting of the dot-com bubble in March of 2000. So a lot of bets have been made on the AI miracle. I don't doubt that there's a revolutionary trend at work, but I think investors and businesses have probably gone much too far in riding the AI wave, and I think that will inevitably correct.
Looking ahead to the next 6 months and beyond, do you think the AI wave will continue to drive the markets go even higher?
It's hard to say. Again, the exact timing of a sharp correction is almost impossible to predict, especially with so much noise coming out of the Trump administration, tariff threats, and other types of dramatic shifts in policy, not the least of which is trying to take over the Federal Reserve system right now. And so, any one of a number of possibilities could lead to a correction. But based on fundamentals, especially my concerns about sluggish consumer demand and an overextended AI valuation risk in the equity market, I would think that some type of correction could occur within the next 6 months.
What is your outlook for the US dollar and US bonds if there is probably a correction in the stock market or the economy face a major recession risk?
Well, there's a cross current of factors at work in the bond market. If the economy weakens dramatically, I think markets will embrace an even more aggressive trajectory for the Fed, and that will lead to further weakening of the dollar. It's not clear that that will be manifested in the form of lower bond yields, which is normally the case in a downturn, because there's been, number one, so much intense political pressure on the Fed, and number two, a massive rethinking of the long-term budget trajectory as implied by the passage of the so-called big, beautiful Bill Act of 2025, which raises deficit and public sector debt trajectories well above what had been the case earlier. And so that will prevent the bond market, I think, from experiencing the type of sharp rally that it normally does in a downturn.
In terms of the political risks facing the Federal Reserve, recently, US President Donald Trump tweeted about removing Federal Reserve's governor, Lisa Cook. So, do you see this as a threat to the Federal Reserve's independence?
Well, it certainly is a threat, whether or not he's going to be able to get away with firing a Fed governor who is a key leading official for an politically independent central bank in the United States. That will have to be adjudicated in the courts. Thus far, there have been no legal charges filed, and it's pretty clear that the act in question took place long before Lisa Cook took up her responsibilities as a Fed governor. She's indicated a willingness to certainly take legal action of her own to prevent this outcome. I think that what could be a very significant challenge of the president's executive authority moving into areas that a U.S. president has never dared to move before. But that's sort of been what President Trump is all about. It remains to be seen how this will turn out. The Supreme Court, in a ruling a few months ago, did underscore the fact that while it gave the president broad authority to take actions to reduce the scope of many federal agencies, that it viewed the Federal Reserve as an exception, underscoring its independence from politics. But I suspect the Trump administration will push to have that decision challenged as well.